Hi, everybody, and welcome to today's Qandor webinar. My name is Matt Siddell, and today I am joined by Paul Watson. He's the head of origination at Blend Network. Paul's a chartered surveyor with 15 years experience across bridging and development finance. He previously worked for Octopus Property, but he's also a developer in his own right. He's done his own deals, and he still gets involved in his own deals. So when it comes to land and development, Paul is a very rounded expert, and he's going to share lots of experience with us today and some tips as well. I'm also joined by Lee Langley, who's the founder and the principal at OnPoint Mortgages. And I remember Lee starting his business 4 years ago in Knightsbridge at my event, and he stood up and said, "I've started my own mortgage business today." And someone stood up and said, "I'll sell you a website then." And he did your branding, and you've been OnPoint Mortgages for the last 4 years. And I think you're lending about 70 to 80 million pounds, or arranging 70 to 80 million pounds of finance every month, including the finance on your own new home, which is a refurb project, I understand, Lee. Although I quite like that brickwork behind you, it's quite nice. You could maybe tag it up with a little graffiti and make it quite funky, I'm sure. But anyway, Lee's a very experienced specialist lending advisor. The business that he worked at before that specialized in difficult mortgages and tricky finance, and Lee is an expert in this field. So just for your own benefit, if you want to jump in and ask any questions, then use the Q&A button at the bottom of your screens. We'll take questions throughout the webinar and try and make it quite interactive for you. And if there are any questions left over at the end, then we'll deal with those questions at the end, and we'll take it from there. Remind me who's going first today. Is it you, Lee? Are you going to be presenting first? I think we're good to go, actually. So if you want to go straight ahead and get kicked off, I can stop sharing, and then you should be able to jump in. Just need to take yourself off mute as well, Lee.
Good afternoon, everybody. I will share my screen.
So I think you're going to be telling everybody things like which lenders will give buyers mortgages for modular housing, because modular housing is becoming quite popular these days. Also, finance for serviced accommodation is a bit of a tricky one. It's easy to do an appraisal and assume that you're going to operate some flats as serviced accommodation, but who's going to fund the development of them? And if you sell modular housing because you're going to be developing modular housing units, who's going to give the mortgages? We're going to be covering a bit of that today, aren't we, Lee?
We'll cover as much as possible. We've got an overview of the entire market today.
Good stuff. Well, I'll get out of the way and let you crack on with it then.
Thank you very much.
Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020, we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today.
Good afternoon, everybody, and thank you to Matt, Rekha, and Kevin for allowing me to speak today. My name is Lee Langley. My hair's different in that picture than it is now, but I am the same person. And I've been in the mortgage industry for 15 years. I don't know how many people were investing pre-credit crunch, but I started off at Mortgage Express, who would do some unbelievable things now when I look back at it. Self-cert mortgages, 130% loan to value, day one remortgages for buy-to-let lenders. It was amazing. I then moved on from there to what's called a specialist packager, who would help specialist lenders distribute their funds, not just to the public, but also to other brokers as well. And then, as Matt said, 4 years ago, I was inspired by his Knightsbridge event to start my own brokerage. And we're not quite doing 70 to 80 million a month. I wish, as Matt said, I'd be able to afford to buy a better home if that was the case. It's definitely a renovation project, but we are submitting in March 8 million of lending to providers. And last year, even during the pandemic, when we couldn't complete on deals for around 3 to 4 months, we still completed on £55 million worth of loans across the year, which isn't bad for free mortgage brokers.
Sorry, Lee, I got carried away and added an extra zero, but I knew it was a big number.
Yeah, not quite as big. So today we will be covering a range of topics. So we will cover residential lending, buy-to-let, holiday mortgages, green mortgages, and also commercial property. So for residential lending, I'm sure there's a lot of developers on this webinar today who are interested in finding out what's the residential lending market like at the moment for when they come to sell on their units. So the big news after the budget last month was Rishi Sunak announced a scheme to get the major 6 banks lending to those with 5% deposit products, to those with 5% deposit. Now, one thing about this is 5% mortgages were available pre-pandemic as well. And actually this scheme was originally launched in 2013 along with the Help to Buy scheme. And it's where banks will guarantee the top 15%. The government will guarantee the top 15% of the loan for banks. Now, one thing about these products is customers still have to meet all of the other standard criteria that banks will have. So there isn't enhancement of affordability, for example. There isn't a change in criteria. It's just lending again to those with 5% deposit. Now, in regards to the rates, at the moment, these products are still being launched. So a lot of lenders are still coming out with their offering. However, there have been a number of lenders, even outside the major 6 banks, who are just offering 5% deposit products again, even outside of this scheme. Because I was speaking to lenders pre the budget, and there was a lot of lenders that did want to launch back into this market anyway. They just didn't want to be the first because then you become swamped with business, and they wanted to keep control of their service levels. So at the moment, rates are not the most attractive at this level. You're normally looking at somewhere between 3.5% to 4%. In addition, a big factor at the moment for residential lending are mortgages for the self-employed. Now, as Matt alluded to, I've recently purchased a new property for myself, and even as a mortgage broker, out of everybody in the chain, we actually arranged a mortgage for the people buying my old property as well. Despite being a mortgage broker, I was actually the last person to be signed off in regards to a mortgage. My wife was signed off first, as she will gladly tell you. My buyers were signed off first, and the onward chain as well. And it's because of the extra questioning for those who are self-employed. So I'm sure a lot of the investors on this call today are self-employed, and you do need to be prepared when you submit a new mortgage application. Now, it's slightly more daunting, but as long as you're prepared, it's still possible to obtain mortgages for the self-employed. And what I would suggest is most lenders are looking at your last 3 months business bank statements to see how you've recovered throughout the pandemic. If you've taken any government support, such as the self-employed grant or the bounce back loan, again, let your broker or lender know about that up front, because lenders will have certain pieces of criteria around this. And with us being at the end of the financial year, we're also at a point where some lenders may well ask for a personal projection for your tax year, April 2020 to April 2021. So it's certainly tougher for the self-employed, but for those who are prepared, it's still certainly doable. And the second element of this is affordability. Now, we were chatting a couple of days ago, and I was given an example of a developer who had built 50 units. And what he was finding was we were struggling to get the mortgage lending to fit, because it seemed that those units were primarily, they were being sold to people who were single. So we didn't have the 2 incomes to use. Now, at the moment, if you're putting in, or if a buyer's putting in less than 10% deposit, you're looking at around 4.5 times as an income multiple. If you're putting in more than 10% deposit, you're looking at 5 times. But a couple of days ago, Nationwide did launch a new product, 5.5 times income multiple, 5% deposit for first-time buyers, as long as you earn over £50,000. So that may well be an opening for those who are on higher incomes to be able to achieve a better income multiple.
That's going to be a popular product, isn't it, Lee? Lots of people earning over 50 grand only want to put down a 5% deposit and want to stretch that debt to 5.5 times their income. It's going to be very popular.
Absolutely. A lot of the criticism around the 5% deposit product was that it doesn't change matters in regards to the income multiple. So I'm sure that this will be a very, very popular product. And if other lenders follow, then that will be great for the market and great for first-time buyers.
And then should I assume that if it's 5.5 times the income and a 5% deposit and 50 grand a year, that the rate is 5% per annum?
No, again, it will be, I'm not too sure what the rate is, but it would be between that 3.5%, 4% that most lenders are offering at the moment.
Okay, which isn't the best rate on the planet, but it's still not particularly expensive, is it?
It's not, is it? I mean, I mentioned pre-credit crunch before where 3.5%, 4% was a good rate. And historically, it's still a great rate, especially for 5%. But when you see headline rates of 1.14, 1.19, it's a big difference, isn't it?
Yeah. I'll let you crack on.
The next step was buy to let. Now, you might be looking to develop a property that you're then looking to hold, or you may well be a buy to let investor. Now, I've put here 80% loan to value, and I don't know why, because there is an 85% loan to value product there with Kensington. But the thing with the 85% products, the rates are expensive. So you're looking at 5% upwards and quite a tough rental calculation to get the stress test to fit.
That 5% rate, Lee, is that for a limited company?
Limited company or personal name.
Okay, yeah, 5% is not particularly cheap. It's not going to help you cash flow for your rentals, is it?
No, and again, there's a lack of competition in that space. And pre-pandemic, that the 85% loan to value products were priced at around about that level anyway. A few more lenders have come back at 80%. Again, limited company rates, you're probably looking at the high threes, low fours at that level. I normally suggest most people try and get to the 25% deposit. It helps with the rental stress testing. And also if you're a portfolio landlord, so you own 4 or more mortgage buy-to-lets, they also apply additional stress testing on your entire portfolio and not just the single property that you're looking to mortgage. And quite often that test requires you to be geared no higher than 75% across your portfolio.
Am I right in assuming that all of these are interest only, not capital repayment?
Yeah, so for buy to let, all lenders will offer pure interest only, then there doesn't need to be a level of repayment.
Okay, thanks, Lee.
And then on HMOs, so HMOs again, we're generally looking at 75% loan to value in the market for HMOs. Rates normally priced maybe 3.25 to 4% with most lenders. And the key for HMO is generally the number of bedrooms. So we've had some lenders who may have previously lent on HMOs of 14 beds, 15 beds, maybe reduce that down to 8 beds, for example. So Kent Reliance will go up to 8 beds on the HMO range. And then their sister company, Interbay, who are the commercial lender, will lend on any property 8 beds and over. So what we're seeing is if you're going up to 8 beds, 9 beds, 10 beds, the rates are generally in that 3.25 to 4% level. If you're going above that number of bedrooms, then you're sometimes looking at commercial lenders who could be 4% upwards. But a really good product is Paragon, because Paragon can actually go up to, I think it's 22 rooms just on their standard HMO range. So again, rates are still priced in that 3.25 to 3.9% level.
Are you going to be covering overseas buyers at some point, Lee, or can I jump in with a question about overseas buyers?
There is a section on overseas buyers.
Then I will pipe down.
We'll come back to that one, shall we?
Yeah.
And then multi-unit properties. So if you're buying a block of flats, again, very similar criteria applies. Generally 75% loan to value, very, very similar rates. And again, with HMOs, you might just want to be conscious of your experience. So a lot of lenders will not let you jump straight from straight into a HMO or a block of apartments without previously having let a single let prior to that or owning another investment property elsewhere. Again, Kent Reliance are very, very good for that because they have no experience requirements for HMO or multi-unit properties. You can go straight into a HMO on your first investment property.
Someone's asked a question about Paragon, which might put you in an awkward spot. So you can exercise diplomacy if you need to. They've asked, they said, isn't Paragon very slow? To which I replied, aren't they all?
They can be. Sometimes it can come down to the preparation of the file and submission of the case to the lender, making sure they have everything they need right from the outset. But you're right, one impact during the pandemic has been on the service of lenders. Last year, lenders were dealing with maybe staff who are now having to work remotely, or maybe they were on furlough. They were having to ask extra questions over and above what they would normally do. And there was increasingly complex situations amongst customers, and service levels have definitely taken a hit. So Paragon are not, as you say, necessarily alone in that.
Yeah, I shouldn't muck about all the time. I'm sure it's been very challenging business circumstances for all the lenders. But your point is that if you work with the right mortgage broker and they present the information in the correct way, it should speed it up.
It should absolutely speed it up, because if you imagine a lender, during the height of the pandemic, there were some lenders who were taking 21 days to assess a new piece of information. And that's where the time really extends out, doesn't it? Because if you can imagine submitting paperwork that gets viewed 3 weeks later and they haven't got everything they need, they come back to questions, it maybe then goes into their 2-week deadline now, 2-week turnaround time after that. That's where you pick up on these horror stories of people spending two months, 3 months trying to chase through.
Gary Walsh, who's a broker in the Qandor Property Club, says Paragon are not only slow, but their underwriting is tough. So they seem to be quite a stringent lender. Anyway, I'll let you push on, Lee. We've got limited time.
Yes, great, Gary being here, not as diplomatic as I was, tell it like it is.
Yeah, maybe I shouldn't have identified him so clearly.
Holiday lets. We've had a few inquiries for holiday lets, and a few from in the club actually. And there's 3 different ways that you could approach a holiday let. So some people have said, well, actually, I want to submit this as a second home. So you can then go up to 80% loan to value. You can use high street lenders like Halifax or Nationwide. Typically for a second home, they'll cap the borrowing to 80% loan to value. But what they will do is they'll assess the loan on your personal income. So you'll need to show sufficient personal income to afford not just the holiday property, but also your primary residence as well. A little bit trickier as well to get pure interest only on that basis as well, because it's a regulated mortgage. You might find that each lender has various criteria around being able to put some of the loan on interest only. The second way to do it is maybe with somebody like Foundation Home Loans. And Foundation Home Loans have a really good holiday let product, but what they'll do is they'll assess it based on the 6-month standard AST buy-to-let rent, and they'll apply the same rental stress test, because they can work on the basis that if it doesn't work out as a holiday let or serviced accommodation mortgage, at least then you can always convert it back into a standard buy-to-let. And the reason why that product is very good is because it doesn't have to be in a typical holiday let area. It can be a property maybe for pure serviced accommodation. For example, we did one in Ashford, Kent, maybe not somewhere that you would holiday, but they had plans to let it to tradespeople, business people, and so on. The final way is a true holiday let product. So similar to that Foundation product, it's at 75% loan to value. And there's a range of lenders that will lend on this basis, going from small building societies who will only lend to on personal name mortgages. They won't lend to limited companies, through to specialist lenders like Aldermore would do holiday let mortgages. Foundation would do these holiday let mortgages that will lend to limited companies. They will assess it rather than on the buy to let rental assessment. They will look at it on a high, mid and low season, and they'll take an average of those. And these can work really well maybe in somewhere like Cornwall, where the buy-to-let rent isn't particularly high, but actually it works really well on a holiday-let basis. I thought I would touch on green mortgages. So in 2018, the FCA and PRA, who regulate mortgages in the UK, they challenged the industry to start to green their mortgage books. And in 2019, the government announced a green finance strategy and put £5 million forward for lenders to start to develop green products. Now we're just starting to see these products enter into the market, and there's no strict definition of a green mortgage, but whether you're a developer, you're selling these units off, your buyers can potentially benefit from these. And also if you're a buy-to-let investor, you can benefit from these as well. Typically what the products look like is they might offer a reduction in the fee, a cashback, a slightly cheaper rate. For example, NatWest, if the property has an EPC rating of A or B, Nationwide will allow you to approach them and take out a further advance to carry out improvements to the property that will improve the EPC rating. And then Foundation Home Loans will offer improved rates and fees for landlords who have an EPC rating of C, of at least C. So again, something to look out for, because we start to see more and more of these types of products launch as lenders get their head around how they can green their mortgage book.
Are the lenders doing that with the support of the government then? Is there some sort of grant funding available to them?
Yes, so they put forward £5 million for the development of these projects and to work out how we as an industry can support the wider government initiatives. Okay,
Lee, we've had a couple of questions come through. I'm going to pick out a couple of quick ones, and we won't spend too long on these because otherwise we won't get through the whole webinar. But Tom Anderson is asking about interest-only remortgages on your own residential home. What are the rates and loan to values look like for interest only on your principal residence?
So for your home lending, they don't change the rate for interest only. Each lender will just have set criteria that you need to qualify for interest only. And this does vary quite significantly, but they're normally around loan to value. So maybe they'll go to 50% on interest only and let you top up an extra 25% on a repayment basis. They'll have specific policy around the repayment of the loan at the end of the term. So they want to see, do you have sufficient pension pot, savings, other property? Could you sell the property and downsize, in which case do you have sufficient equity in the property to do so? And then not all lenders, but some lenders might have a minimum income requirement for interest only, which could range from 0 to up to 100,000.
Okay, so at 50% loan to value, interest only, the rates are very palatable, right? Below 2% per annum.
Yeah, I mentioned those headline rates, and when you're at 60% loan to value and below, there are incredible rates out there: 1.14, 1.89, 1.19.
Like the sound of that. David Tiffin's jumped in with a question about, he says, are there any lenders lending on flats that have cladding issues yet? Grenfell Tower cladding issues that have obviously affected the whole country.
This is really difficult at the moment. I've taken some time off because of the house move, and just before I took the time off, there was an announcement that lenders are going to start working with RICS to resolve these issues. I haven't seen the full outcome of that yet, but it has proved very difficult. We've got a few clients that we're holding on, reviewing the market every 3 weeks or so, just to see how matters change.
But at the moment, what's it looking like?
At the moment, this isn't the best answer, but for in some situations, we've literally had to say it's going to be subject to the surveyor, whether he deems it a requirement or not. We did have one case for a landlord. We submitted it to one lender, surveyor wasn't happy. We then submitted it to a different lender, and that surveyor was fine. But that building had a very small amount of cladding on it. It depends.
So at the moment, we've got lots of people who've reached the end of their mortgage and they're not able to renew because they're in a high-rise tower that's got cladding risk.
there's huge numbers of there's been huge numbers of mortgage prisoners who are stuck. And I mean, if you're not looking to move, if you're not looking to raise any extra funds, you could do a product transfer with the same lender and switch the product. But it's been a huge issue.
Yeah, I was on the train coming back from a meeting in London yesterday, and I pointed out that I used to own a flat in that tower, and the gentleman I was with said, well, you're lucky you don't own it anymore because you might have had some cladding issues on that one. Another point here, Nikki Weatherall's shared that Kent Reliance have been quick for us, plus we have a 10-bed HMO mortgage with Land Bay that was really quick, and we were impressed with them. That's a good share from Nikki. Thank you, Nikki. Lee, I'll let you push on.
Next slide was going to touch on commercial property and semi-commercial property. So at the moment with commercial mortgages, it has been a difficult time over the last year. A lot of lenders have maybe entered the market and then lockdown has occurred again and they've pulled back from the market. So definitely something you want to speak to a broker about in regards to trying to find the right option. The commercial divisions of high street banks still in the market, normally looking 60% loan to value, but they'll want a level of amortization in there. We get a lot of clients who are looking for higher loan to values than 60%. Maybe they want pure interest only. Shawbrook have still got a commercial range, goes up to 75%, but at the moment in the commercial space, you're really looking at rates anywhere between about 5 to 7%. And you really want to be conscious of what type of commercial premise it is and the impact on the business or the tenant in that property of COVID and the pandemic. So that's something certainly to be aware of. Semi-commercial mortgages, slightly easier in that regard because there's still a residential element. Again, if you go to that specialist market, maximum 75%, probably looking at rates high 4s to 6% in that region. With those specialist lenders, pure interest only is still available. You've got to be conscious of experience again when it comes to commercial and semi-commercial. I've got one client that wants to jump straight into commercial investment property. Not impossible, but difficult. We did a good loan for a customer who bought his first investment property, which was a Barber's on the ground floor residential unit up above that he was going to convert into a HMO. We were able to get him funding by going to a bridge loan initially. They were happy with his experience in carrying out the refurb because he'd done a major refurb to his own home. So there are some products out there, but they're certainly limited at the moment.
Well, commercial property is getting very popular as the restrictions on Section 24 and limited companies and the rates and overseas buyers with their extra 2% stamp duty and the fact that their mortgages cost them even more because they're overseas shareholders of limited companies. So commercial property is becoming quite popular. You make a good point there. Lenders want to see a little bit of experience, don't they? It's not a newbie strategy because you could get left on the hook paying the business rates after that 3-month business rates holiday that you get when your tenant moves out or potentially goes out of business.
And absolutely, I guess also there's two different elements here. I was approaching it from a perspective of the long-term funding, maybe once you've carried out a development, and Paul might have some thoughts, but in regards to the initial cost for a refurb, a conversion, there's definitely a lot of good bridge options and development options out there with some flexible criteria for good projects.
Stop the webinar. We've got a very good inquiry. This looks like an inquiry for you, Lee. I'm joking about a little bit, but someone's asked, what's the best rate for a 50% loan to value on a £1 million residential property? I think you emailed Lee personally for that one, but we're talking about the likes of Scottish Widows, aren't we? And they're about, what are they, like 1.6, 1.7?
Yeah, I again, just before I headed off for the short annual leave at 50% loan to value, I saw a product here was 1.18, 1.19.
Wow.
It all depends on the loan to value of that £1 million house. If it's
at those levels as well, don't you recommend offsets? That's what we did, isn't it?
Offset's a great product, isn't it?
Yeah.
If you're an entrepreneur, if you're a business person, if you've got large savings, you can bring down your mortgage payment, but you've always got those funds that you can access quickly if you need to.
Are we nearly there, Lee? I've got a bunch of other questions that I want to run past you before we wrap up.
This is the quick fire round, just quick tips. What we've seen is when people are coming off their short-term finance, their bridge, their development loan, just things to be conscious of. Company setup. Sometimes people can make it difficult by buying property in a trading company, which not all lenders will lend to. Experience, which we touched on.
Well, wait, because we mentioned this before. The company setup, it can be as simple as using the wrong SIC code, can't it? If you use the wrong SIC code, the computer says no, and you won't get your funding.
Yeah, or having the property in your specific development company, and then there's some long-term lenders that don't lend to development companies. So it's something which can be simple but can cause big issues. This
might be a bit of a tricky question, so I don't mean to test you too badly, but in a lender's eyes, when does a trade become an investment? Where's that line crossed?
Yes, so sometimes it can be, just imagine I've got my mortgage business and I went and brought property into my mortgage business. They'll clearly see on the SIC codes it's set up for other purposes other than the buying and holding of property. So in that instance, it's quite obvious. Other scenarios, you might have a development company and then you switch that over to just a property that will buy and hold property. Each lender's got slightly different criteria on that, and it depends if they pick up on it or not. They normally just do their company's house search.
Okay. Where are we up to? Expat, I think, or experience?
This was your question earlier, wasn't it? So there are still lenders available for both expats and foreign nationals. Normally, the first project is the most difficult. Once you own a property and you've got some track record in the UK of having a loan, or if you've got credit in the UK already, it then becomes easier. But the first project can certainly be difficult. And again, we've had some inquiries previously where we found a couple of straight to term options recently, but the pricing is normally around 5%. But these are specialist buy-to-let applications, HMOs, blocks of flats. If you're looking at a foreign national who is maybe buying a property for property first time, maybe they could acquire the property on bridging and then move on to term funding later. We've got some clients who would prefer to buy a property in cash, gain some experience of letting in the UK, and then we'll refinance them later on.
We've had a couple of big inquiries recently because Sean, who's in the club, is based in Singapore. He's got 12,000 Chinese investors on his books, but investing through limited companies so that they can offset the interest and getting the debt on their rentals is quite expensive, isn't it? It's quite hard for them to get a rate below 5%. Is there any change on that yet?
Not at the moment, especially when you're looking at those more specialist buy-to-let investments that they might be looking to do. We have quite a common scenario where we've got somebody that's based in the UK and an investor who's abroad, and quite often in that scenario, if the investor is not a director and owns less than generally 20% of the shares in the SPV, they don't necessarily have to go on the application. So you could get a mortgage through with Foundation Home Loans or somebody like that on a 3% rate. But no, it's a complicated area at the moment.
Okay. Last couple of tips, Lee.
Property, just look out for the types of properties that you're investing in. Anything over commercial, look out if it's food-based, noise. If you touched on modular construction earlier, the high street lenders really are looking to support modular construction. So if you're building out a development and you're looking to sell it to residential buyers, it's probably easier at the moment than if you're looking to build a property using modular construction and then look to keep and hold as a single buy-to-let, for example. And then rental assessment. If you are developing a property and you might be looking to hold it, just don't forget that industry standard rental calculation of stress tested rate on an interest only basis of 5.5%, and then the rent needs to cover that by 125% if you're putting it into a company. Because if it doesn't fit on that calculation, maybe the only way you could make it work at a 75% loan to value would be to fix in for 5 years, because there are some lenders don't necessarily need to apply that industry standard calculation on their 5-year products. And we've had a few clients who have maybe been looking to sell, maybe haven't been able to sell for the right price, have chosen to hold, but they can only get 75% by fixing in for 5 years.
And that notional rate, did it used to be 5.3, but now it's 5.5, the notional rate?
So it was 5.5% for the last five years or so.
Okay.
Before that, there was no real specific industry guideline.
Okay. I'm conscious there's still a few questions here. Lee's contact details are on the screen. The webinar is being recorded and it'll be on the Qandor website, hopefully by the end of the day or first thing in the morning. We've also set up a LinkedIn for those of you who want to connect with one another or copy paste your questions to Lee into the LinkedIn so that Lee can answer them himself on the LinkedIn post, and a member of the team will share the LinkedIn link in the chat right now. But I think I ought to move on to Paul Watson. Lee, thank you very much for that information. It's always great to catch up on the lending market to see what's going on. And I always love the tips that you give as well, because there's all sorts of silly little things that could trip people over. Great set of slides, very nicely delivered. Paul, are your slides ready? Are you ready to do your presentation? Just need to take you off mute, and here we go.
Hi, Matt. Let me just share my slides 1 second.
Do I need to do something? I think I need Lee to unshare. There we go. Then you should be able to share. That's working nicely. Go on to the slideshow. There we go. Over to you, buddy.
All right. Well, thank you, Matt, first of all, and Team Qandor for the opportunity this afternoon. So looking forward to giving this presentation. Really, when we're discussing ideas over how to present and what to present, we decided to put something together to allow me to explain to brokers and borrowers how best we like to see deals presented to us. So just to say hello, I'm Paul Watson. I head the origination team at Blend Network. We're a peer-to-peer crowdfunding platform based in London, doing deals across the UK, really between 150,000 pounds of debt at the bottom end, up to circa £5 million at the top end. So that's everything through from HMO type deals, whereby a borrower is buying a dwelling, doing their PD, converting it to an HMO. And we structure that as a development facility, all the way through to things such as an office to resi or new build housing and everything in between. So as Matt briefly said to everyone earlier, I'm a chartered surveyor. So I spent the first 5 years of my career at Jones Lang LaSalle buying and selling central London development sites. I moved on to work at RBS after that for 6 years as an investment manager initially, but then latterly as a development manager. And it's only recently I've really been involved in the funding and financing side. So I'm really a property man at heart. But I've moved into the funding world over the last 4 or 5 years. So initially that was at Octopus, doing larger development deals, really £3 million plus, and latterly at Blend Network. So I was approached by a guy called Jan Merciano to join him to help build Blend into a bigger business. So here I am. This is my presentation. I hope you find it enjoyable. Really, when we see a loan inquiry, there are various tips that I can impart to help borrowers and brokers really present those deals as easily, as accurately, as simply as possible, to allow us to get a good overview of the deal itself, of the opportunity, and ultimately as to whether it's one that we can support. So the first tip is put it as a bullet point as business plan. What are you trying to achieve? Are you building new build houses? Are you doing a conversion? What is your exit? How are you going to get from start to finish and exit successfully the scheme? That is really supported by an accurate set of numbers. So the more detail, the better. So purchase price, stamp duty, legals on the way in. So all together being a gross purchase price, but also your build costs. I mean, we're if we are supporting this deal, we're going to really analyze those build costs, check they're appropriate, look at them on a global basis, look at them on a unit by unit basis, break them down on a per square foot basis. So literally, the more detail, the better. And we'll look at things like the costs of, if you're putting a lift into a scheme, how much that lift is going to cost, whether it's in line with the market, and we'll work very closely with our professionals, our QSs, our valuers, just to check that it is appropriate. Then we'll go through things such as professional fees. So who's your professional team, your design team? Who's your architect? How are they being appointed? Who's your engineers, your civil, your structural engineers? And again, checking that their prices, their costings are in line with what we'd expect it to be. So again, a breakdown of professional fees allows us to assess that very quickly. We can then move on to some of the more laborious points of things like SIL and Section 106. I mean, they're a necessary evil. SIL, there's no getting out of it. It's a cost of development. So really understanding how much that is critical for us to be able to analyse the deals on the way in. And also Section 106, whether there's any contributions, whether there's any affordable housing, if there is affordable housing, whether it's being pre-sold, the likely demand for it. So we really get our heads around exactly what is going on the numbers side. Typically with
Paul, go ahead.
I was just going to say, moving just quickly on to contingency, we would typically expect any build costs to have a contingency on top of it. But this contingency is not just the build cost, it's more of a loan contingency, just in case things do go wrong. That's something we'd like to see from the borrowers and the brokers in the first place, and we'll make our own kind of analysis over whether we think that's appropriate. But sorry, Matt, you were going to jump in.
Yeah, well, I've got a couple of things here I wanted to mention. Like, first of all, on the contingency, if the job isn't priced and there isn't a contract that's signed, then the contingency would presumably need to be more like 10%. But if there is a contract and the builders sign the contract and it's all wrapped up, you'd still want the contingency in there for variations, wouldn't you? What sort of contingencies are we talking about?
Yeah, absolutely. So typically between 5 and 15%, depending on how complicated a project it is. If it's airspace development, for example, we'd expect closer to 15%. If it's quite a straightforward conversion, then perhaps closer to 5% level. Yeah, but again, it's not just
things like access are going to really affect that. If you haven't got any access, then it's obviously going to be a tricky site.
Yeah, and I think that's a good point. I mean, it's not just for build. It could cover, potential legal issues. It could cover cost overruns. It could cover delays on site. It could just cover the additional costs of being in a loan framework, which the documentation is pretty watertight, so it allows a little bit more flexibility. So actually, I say to borrowers and brokers, contingencies are a good thing, and the higher they are, typically the better as well. So it just offsets the risk of those rainy day events, those events that do happen that nobody plans for, just to protect our position, which ultimately is protecting the borrower's position as well.
So is it fair to say that as a lender, you're not a fan of seeing these appraisals come in at £125 a square foot with no contingency and nothing in there for the external works?
Yeah, not a fan. I mean, to be honest,
you see it every day, though.
We see a whole array of appraisals. I mean, some really basic, just in email format, just in the body of an email. Others in quite detailed spreadsheets. And again, it's just something that it's not just the more detail, the better. It's making sure the numbers are accurate and appropriate for that scheme. And obviously, the more experienced the borrower is, typically the more in line with and more accurate they are with their numbers. So at the end of the project, they look back, and if they've done lots and lots of PDs, they really know where all their money is being spent and how much things are going to cost. So yeah, the contingency does protect us. It protects them as well. But on the appraisals, really, the more detailed, the better, so we can get our heads around it and just check we're comfortable with it. And then finally,
hearing you, sorry to cut across you, but hearing you talk reminds me of about 5 years ago, I went for a drink with a team that you worked with. Actually, I won't go into names because it's irrelevant. But we were in the pub having a drink, and I think we just signed a deal. And I was listening to them talk, and they're saying, "I don't want to own that asset when that's da 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 da." And I thought it's interesting how he's talking about owning the asset. He's got first charge, and he's lending for a relatively low return, which is fixed and paid before the developer gets his profits. But that is the mindset of a good underwriter. And this particular underwriter had never lost any money. Because he was very, very good at managing the risk, but he thinks of it as owning the asset. I'm only going to make a lower return, and I'm not prepared to lose any money. So that's why it's so important to get it absolutely spot on, because you do want to lend as high as you possibly can do without breaching your own covenants from your own funder. And if you're going to be competitive in the marketplace, then you need to know how to be there without being the wrong side of that line. Is that right?
Yeah, I mean, I agree with that. I mean, we look at it as an investment opportunity. So, would we invest in this deal? It's not just typically we're lending money. We want to lend as much money as possible out the door. It's more, a good deal to us is something that we would invest our own personal funds into, and we would fully expect to be repaid. And obviously, you don't know whether it's a good deal or not until you do get repaid or not. But we treat it very much as something we're putting our own money into, and we analyze it that way. And we look at it almost as a joint venture structure, where we're putting the lion's share of the capital into the project, but the person creating the value is the developer. So it's really supporting them to achieve what they want to do and hit that GDV. Or improve on that GDV, and then be able to trade out at good numbers and pay us back and anybody else involved in the project. But that was my last point. There was GDV, really kind of a breakdown, and it takes me on to the next bullet point as well. A breakdown of that GDV, how much is going against each unit. On a flattered scheme, if you're a house builder, for example, you would price every single individual unit. We don't quite go into that much detail, but again, we look on a global basis. We check out comparables. We look into the market, check liquidity. We check the pricing is on point for each unit and actually quite accessible.
What are you using for your comps? Property data?
Yeah, we use property data. We use Rightmove, Zoopla. Any tool that's really available to us is available to borrowers and to the brokers. But we just want to check that it is a liquid exit. We're not going to take a risk on something that we perceive as being illiquid on the exit. So it's just how achievable is that GDV, okay. And we look at it on a unit by unit basis.
The clock is ticking, so I better let you crack on. There are a couple of questions here about planning, but we'll get onto that if it isn't covered in the slides.
Fine. The next one is planning consent. So obviously we look into the planning consent as part of the business plan, what you're proposing to build, and really kind of getting immersed in the detail, whether there's any conditions associated with that planning consent that could be onerous or could be difficult to discharge. Once we've kind of got through that, we'll look at the borrower as well. So look at their track record, their developer CV. So again, the more detail involved on that, the better. Typically, I'd like it on a project by project basis, so we can see, what they've developed in the past, how much their build costs were, how big a project they're comfortable undertaking, what the kind of GDV and profit levels coming out of those were, what type of deal it was, whether it's ground up conversion. So that really allows us a kind of good understanding to see whether the person creating the value, the borrower, is going to hit that GDV on time and to budget. So we really give that the once over. We ask them who they borrowed from in the past, specifically development finance from in the past. Check there hasn't been any issues with that. And it's one of those, the more open, the more honest that people can be with us, the easier it is for us to make decisions, because we're going to find out anyway, but B, also kind of getting to that decision as quickly as possible. Just to move on, build procurement, obviously essential. How are they going to deliver the GDV? Is it a third-party contractor? Is it self-build? If it's a self-build, does that mean we need a higher contingency? Have they got the right experience in packaging up subcontractors? Are they building it with their own bare hands? It's really important for us to understand, how the construction risk is being mitigated. And from all these deals, two biggest risks are construction risk and sales risk. So if we can get comfortable with the liquidity on the GDV, it's really the focus. The eyes are on build and how the damn thing is being delivered. Then just moving on, equity contributions, A&L. So again, equity, hard cash coming from the borrower. Typically, we would link that with experience. So the more experience a borrower has, the less hard equity we would expect them to put in from their own back pocket. If they've proved time and time again they can do it, then we would take a view and be expect that to be a smaller portion. If they haven't done it many times and there's question marks over their delivery experience, their developer experience, then maybe would expect them potentially to put 15-20% of total costs in as their cash contribution. Again, an ALL form allows us just to see if you're a developer who's done it many times, would expect you to have done quite well out of it. So it really just allows us to understand exactly their background, their worth, their success in the past. And then just the final 2 points are really timeframes. So any development loan has a build period and has a sales period. So they're combined in a loan framework and a loan structure. And it's just making sure that we just assess, the build period and the program is appropriate, and we use our QS for that. But also that the sales period, and that's obviously linked to liquidity, is appropriate for that scheme. So we don't want borrowers to default. It makes their life difficult. It makes our life difficult. So we want to be sensible in terms of the loans we are issuing. And then finally, exit strategy. So whether they're selling, refinancing, whether it's a guaranteed exit, if so, how likely is that guaranteed to be? Who's underwriting the exit? Is it a pre-sale to an affordable housing provider? Will that exchange be prior to the loan completing? All of that on that slide there is essential to allowing us to make a very quick decision. If that's not presented in the first place, what we end up with is a lot of questions from my originating guys, going back to brokers, going back to borrowers, asking for more information. Or in a worst case scenario, and I'd really hope that we don't end up in this position, but a lender could issue terms that they won't stand behind. So they'll only have half the information provided, they won't ask the right questions, and they'll issue a loan that the underwriters, the company would never support, which just creates a mess and often has cost implications to the borrower. So they're all the key points that I'd expect to see. If I don't get them on any loan inquiry, I generally go back, pick up the phone, go back by email, and try and get the answers to them. And they're absolutely critical for us to really analyze that deal.
It doesn't look like too much on one slide when you look at it like that, but that is the bare essentials, and there is quite a lot that you do need in order to make an informed decision. I can already tell we're going to miss the 3 o'clock proposed termination time for the webinar, but we will go by 10-15 minutes. We've got some really good stuff that we're going to cover, so don't leave unless you absolutely have to. I want to ask Paul later on about planning risk. I want to ask you about outline planning. I want to ask you about planning uplift and whether that can be used as equity. I'm not going to get a chance to do any of that before 3 o'clock, so if you can stay with us, do stay with us. Next slide, please, Paul.
Yeah, so the next couple of slides, shouldn't take quite so much time. So the critical slide was the last one, but in terms of the keys to success, I mean, just be open with us, be open with your lender. So, if there are issues, potentially an insolvency background, for example, just disclose that to us. I mean, it's not necessarily a deal breaker. We will, if you don't disclose it, we'll find out about it. But if you do, then, that's a big tick in the box. So,
you're going to find out anyway, and you're going to burn trust and goodwill if you don't cough it up at the beginning. It's better.
Yeah, it's a first step to building that rapport, which is critical. So be open with issues so we can mitigate, we can plan, we can propose solutions. So that's the first thing. Second thing is don't sprinkle the deal around the market. I mean, it happens time and time again. My personal view on it is it reflects badly on the borrower. So if that happens, it makes us think, well, look, really, does this person really know what they're doing? Are they running a tight ship? How have they got so much time that they can call up every lender in the market, call up every broker in the market, send it to absolutely everybody? And what happens a lot of the time when that happens is they often, for some reason, send different packs to different brokers. So the numbers are all different. So we may see the same deal from two separate brokers, but both presented in different ways with different numbers, and it just creates an absolute headache. A lot of work goes into these at my end, so it can be quite frustrating, and it's a big no-no. Also, being accurate with numbers. So it goes back to my last slide, but also that works both ways. So when a borrower is presenting a deal to us with those accurate numbers I'd expect to see, and we get comfortable enough to issue some terms, really understand those terms. So it's not just their numbers, it's they understand the numbers that we are issuing to them. They understand what their net day one loan is. They understand how their interest is about being calculated and whether it's rolled up and compounded or whether it's retained. So it's basic stuff like that. And if they don't know, they should ask. So I'm more than happy to spend time on the phone to people just running through how the debt structure works. And then finally, a target completion date is always useful to have early on, so we all know how quickly we've got to drive these deals through. So, just at the beginning of the inquiry, I need to complete this in 4 weeks, 6 weeks, then we know exactly how quick we've got, how much time we've got, so we can get our ducks in a row and just be, very organized my end and ensure we're helping as much as possible and not creating issues by, creating delays.
I think that second point on there, go back to the previous slide, Paul. The second point, which says, do not sprinkle the deal around the market. I think sprinkle, it's an SP word that you normally use, but I don't think it's sprinkle. But that really turns you off, doesn't it? When you know that, when you've got an opportunity to come in and then your colleague looks over your shoulder when we're not all stuck at home and the colleague says, oh, I had that last week. It's sort of like, oh, you know what, this guy's just giving it to everyone. I'll look at this other deal and this other opportunity rather than spend all afternoon looking at something that's probably given out to the whole market. And it really is a big turn off, isn't it?
Yeah, we lose confidence. So, if confidence has lost, the trust then starts being erased, and it creates issues. So, that would be one of my kind of nuggets, if I'm allowed to use that word. And
Insights.
then final
nuggets is for Peterborough.
Insights. And final kind of main slide is, post completion. Everybody understands the construction is complex. It's difficult. Very, very few people get it. In fact, nobody gets it right all the way through. So when there are issues, with your lender, flag them. Make sure they're aware. If your contractor's gone bust, for example, there's no point in leaving it until the next QS visit for them to find out kind of indirectly. That's going to affect obviously the loan. If we are aware on day one, we can help create some kind of solution to that. So be as open as possible. Markets move, so obviously build materials, if you're not on a fixed price, or the GDV changes throughout the loan. So just be aware of that. Again, the lender will be looking at it, we look at it, the borrower should be looking at it as well. And getting prepared for exit as early as possible. So really having a very clear business strategy, a very clear exit strategy is critical. Are you dressing a show flat? If so, are you buying, are you renting the furniture? How are you managing that? If you're going to refinance, put them onto a development exit product, are you talking to the right lenders and are you giving them sufficient time to allow them to put that product into place at the right point? And finally, just open dialogue. So just keep on talking. We like to talk to our borrowers regularly in our loan book and just make sure, that everything's going well. If it's not, that we can help them out as much as possible. Then in terms of, questions, this slide just gives a little summary of the type of deals we do. It's up to date. We're going up to 68% against GDV at the moment, circa 90% on costs. We do have some family offices that take MES positions behind us. So we put them into some of our loans. That allows us to go a little bit higher, up to say probably 75%. So that's a pretty strong card for us to play on the right deals. But yeah, we're in the market, we're open for business. Matt's got my contact details, and very happy to take any questions. Just before I end, I'd also encourage you all to register on our platform, which is at www.blendnetwork.com. We do have a lender side and a borrower side. We do send out market information. We have a monthly pulse, which gives a commentary on what's going on in the market. It's really, really insightful. And I'm told that if we get some people off the back of this kind of registering today, then there will be a nice bottle of champagne going to one of them. So Matt, I'm not sure whether you're allowed to register and whether that counts for you.
I've registered 50 times. 50 different Gmail addresses,
no
bottle of champagne. Yeah. I've got a question about your 9% loan to cost. Does that include your interest and your arrangement fees and therefore reduce the day one loan?
So when we look at costs, we're really talking about purchase price, and we're talking about the build cost, the delivery cost. We're excluding the finance costs.
Okay, so it'd be 90% of costs excluding finance.
Yeah,
and
exactly.
Also, when people present deals, whenever I present my deals, I would always include the cost of sales, the estate agents to sell and the legals to sell. But some developers, as far as I'm aware, exclude those costs on their appraisals because it obviously helps the deal stack up. What's your take on that? Should you include marketing and sales costs on your appraisal or not?
No, we typically don't. I mean, the reason we don't is because they're being paid out receipts anyway. We had the first charge. We're looking at the GDV. We're analysing the GDV. At that point in time, we would be very hopeful the project's been a success, and we're talking about a small percentage. Obviously, if you're a borrower, it is a key component to your overall return. But because it comes out receipts, we're relaxed over it.
Okay, so we're at 3 o'clock right now. We've got time for some questions for anyone who wants to stay on. I've just got to do a bit of a reminder to everybody. I've got some great questions. Well, I still want to ask you about outline planning. I still want to ask you about planning uplift and whether that equity can be used. But I just want to remind everybody, the next Qandor webinar is on the Wednesday, the 12th of May. So put that in your diary, Wednesday, the 12th of May. It's going to be Arthur Johnson, who runs his own construction business, which he's run since he was about 27, I think. And Michelle Lowe will be joining me to discuss construction costs and construction risk, looking at how Brexit's affected prices and obviously the pandemic as well. I just want to give the club a quick plug as well before I ask some tricky questions. But if you want to contact any of the speakers today, you can email us via the Qandor email address, which is info@qandor.org, and we will connect you with Lee, or we will connect you with Paul Watson. If you're interested in joining Qandor, there's a link in the chat, which my team will share again now. If you're interested in talking about Qandor, which is our club for property developers, investors, and property business owners who are already involved in multiple unit new build developments, £1 million plus, then book a call with me to discuss that. If you're interested in Tropolis, you can use the same link to book a call with me to discuss Tropolis Property Academy. I think we should get back to the Q&A so we can cover that.
Hi, I hope you're enjoying the free content. My name is Matt Siddell. I started Qandor in 2017. In 2020, we launched a property academy called Tropolis. If you want to know how you can come and join our fantastic network and work with the wonderful people that we help and support, then click the link below and book your call with me today.
What's your view on planning? Can developers use the uplift in the planning consent as equity to get their deals funded with you or with other lenders?
So in terms of, sorry, I think you said Lee there, Matt, but obviously you're not talking to Lee. I think that's direct.
I probably did say Lee, I meant Paul.
So yeah, in terms of, there were two questions there. So in terms of soft uplift, hard uplift, planning uplift, we typically allow an equity contribution on planning gain, but cap it out at say 50%. It depends. It's kind of taken on case by case, but even with planning uplift, we would expect some hard cash going in on every single deal. The only time we really might not expect it is if it's a JV with a landowner, but we would want to take a security from both the borrower, from the developer, and from the landowner as well.
Okay.
And your second question, sorry, was
planning risk. I mean, most development finance companies don't want to get bogged down in planning because it is unpredictable. What are your comments on planning risk? Rav Kumar was asking this question.
Yeah, I mean, I'd like to say we do support it. I mean, planning risk is really an equity risk. It's not a debt risk. There are cases whereby we might be able to get comfortable with it. We've really got to understand the detail though. So what the reserve matters are, how they get from the outline to the detailed, what happens once they get there. What we don't want to happen is the borrower being on an outline consent and take a lot of time up to get to the detailed consent. And even if you do get a loan out of us, it's probably going to be quite low geared, so really 50% max. So just bear that in mind. It's not really flavor of the month. It can be done. It's difficult to get it done. But ask the question. If you don't ask, you don't get.
Well, Rav's exact question was actually, it sounds like the inquiry is better to come through after planning is achieved. But I don't think that's necessarily right, is it? Like you're happy to start work as soon as the developer's secured the deal.
Yeah, I mean, all the deals in our whip, deals that we're looking at and trying to take fees in and advance them. I'd say probably half of them have detailed consents, half of them don't. The half that do have the detailed consents, generally the borrower is buying the site. The half that don't have the detailed consent, generally it's because they're going through planning, but they also want to start their funding, so they've got that secured. So they're very confident they're going to get the consent, but they also they also want to start their funding, so they've got that lined up at the right time. There is a bit of a risk with that because obviously to access funding there is a cost involved, so it's really dependent on financial situation, how likely it is that you get the consent.
Thanks, Paul. Great set of slides. Sorry if there's a bit of pressure on you to wrap up fairly swiftly, but I think we actually covered it all quite nicely. And we've held quite a large audience throughout this webinar, so that's a result. Lee, you volunteered to answer Tom Anderson's question live. If you want to go ahead and do that, that would be great.
Yes, so Tom asked, if a house is split into 2 or 3 flats, all on separate titles, is that still considered a multi-unit block for funding purposes? So whether you've got a block that is split into where the flats have separate leases, or they're all just under one title, if you try to fund that block in one go, it's still considered a multi-unit block. So you'll be looking generally at rates 3.5% upwards, whereas if you were to fund each flat individually at the same 75% loan to value, you're probably looking at 2.5% upwards. One other, I almost said nugget, then one insight is we've had some clients who have got, say, a block of 18 apartments that are small in size, so they're under 30 square meters, studios under 30 square meters. In that instance, it can be easier not to create separate leases and fund it as one block, because then you don't run into lenders' size requirements, because lenders view it as just one clear investment opportunity, and they're more likely to lend even when the size of the studios are below 30 square meters.
Okay. But obviously, one thing that investors quite like to do is to split the titles and go on separate mortgages from separate lenders so that they're not exposed. What's the right thing to do?
I don't think there's a general right or wrong answer. It's just dependent on what the customer's looking to do. I mean, if somebody's looking to maybe start to sell off individual flats in a couple of years, they might want to put them on their own mortgages, and they've got greater flexibility. Some developers don't want to pay the cost of splitting the leases up front. So I think it just depends on what you are aiming for from that particular block.
If you want to sweat the asset, is it probably best to split the title and go onto cheaper separate mortgages?
Yes. Yeah,
okay. And I think you also volunteered to answer Victor Lai's question. He's asking about social housing and supported living. What does the finance look like for social housing and supported living, Lee?
Yeah, I flagged this one because it's probably something I should have mentioned in the webinar, because we get a lot of questions about this, and it is possible, but there are only a few lenders in the market that will do this. So sometimes Fleet Mortgages, a small building society, West One, who were a bridging lender, have now launched a buy-to-let range. They'll consider some social housing supported living options as well. So it is possible, but again, you need to go to the right lender.
And the last comment in here was from Gary Walsh. He says, as a broker, I get numerous appraisals across my desk every week. Bill costs range from the sublime to the ridiculous, £75 a foot to £250 per square foot, even for similar projects. He says it is the hardest element of the stack to get a handle on. When the lenders and PMS reviews the deal, it often aborts. And he comments that bill costs are also rising, which I think is a fair point. And I think that is a wrap. Excellent turnout today, and managed to hold the audience, guys, which is very well done. I just have to say thank you to Lee, and thank you to Paul, and thank you to the team for arranging all this, and thank you to everybody who attended, which made today a really good success. This is the awkward bit. I don't know how we finish the webinar without saying goodbye to each other, but I think you just hit the button and then we're done. But maybe we'll have a little after party. I'll email you guys a link. And don't forget to join on the LinkedIn link. I think that should still be in my chat, but I think the team have posted that link for me as well. So we'll leave that open for a minute. Yeah, join us on the LinkedIn, get connected. And if you're interested in the club, then drop me a line and we'll have a call. Thanks very much for joining us. Take care.
So if you enjoyed this video, why not check out some of our other videos? I recently interviewed lots of fantastic people. There's loads of good content in there. Thanks for watching. I hope you enjoyed it. I'll see you in the next video.